The global economy is on the brink. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, we're seeing economies in freefall as countries worldwide are on the brink of plunging into a deep, globally synchronized recession. Let's over to Bloomberg, where he picked today's story up with the headline, U.S. Treasury Secretary Yellen sees lower U.S. recession risk as consumer slowdown needed. Now, I wanted to point this article out first before we get into, the globally synchronized downturn that has already started to happen, because I want you to see that policymakers cannot see this. And many people wonder, are they just blind to what is going on? Well, I'm going to let you be the judge, but let's take a look at what Yellen is saying. On the chance of recession, she says, my odds of it, if anything, have gone down, if you can imagine that, because look at the resilience of the labor market and inflation is indeed coming down. She says, I'm not going to say it's not a risk because the Fed is tightening policy, as she alludes to their 10 interest rate hikes since March 2022, with more to come. So here we can see you saying, look at the labor market. Now, we know the labor market is a lagging indicator, particularly coming out of the pandemic, because during the pandemic, a lot of employers laid people off. People voluntarily retired, and now what we've seen as the economy reopened, people came back into the workforce, employers trained them, and then immediately faced a slowing economy, and now they don't want to let them go. So the labor market, at least as we're going to see, looks strong for the moment, but the only question we have is for how long. And the idea that the labor market is going to hold up here, as Yellen's suggesting, well, I think that's not true at all. Because here we can look at the chart of the 4-week moving average of initial claims. Now, it just broke over 250,000, which I'm making the case is kind of the line in the sand where we should start to see an acceleration higher of initial claims. Now, there's two lines on this chart, one at 350,000, that's in green, and one at 250,000, which is in red. And what I want to point out is anytime you get kind of a trial in initial claims, and you can see that throughout the chart here, that there is sort of a breaking point for the economy that once it gets over a certain level, well, it just doesn't stop. And that number typically is 350,000 weekly claims. Now, what's notable, though, is when we have a period of where there's very low initial claims, and you can see that going back into the 70s. We see that here into the 2020, and we see that now. What happens is the number that the economy has to pass over is 250 weekly claims on average. Now we're just starting to hit that. So if that is true, if that holds out, then what we should see is that number start to accelerate in the weeks to come. If it is indeed the old number of 350,000, well, then it's not a big deal, and perhaps Janet Yellen is right for now. But so far, the U.S. economy has proven resilient. A May employment report showed job gains beating all economists' forecasts. Home construction and retail sales for last month have also shown surprising resilience in the face of Fed's aggressive monetary tightening. Of course, one thing we can note about retail sales is they're not adjusted for inflation. And the moment we start adjusting them for inflation using the best means we have possible, well, suddenly retail sales don't look that optimistic at all. And here we can see advanced retail sales adjusted for the consumer price index. And here we can note that indeed it is negative. It is contracting against inflation. We can see it's done that before during the global financial crisis and just a little bit during the dot-com bubble. So why do you see these policymakers looking at the headline numbers say, look, retail sales are up? Well, because prices are up too. But when you start making adjustments for the increase in the consumer price index, then what you find out is that indeed retail sales are slowing, which validates all of the earnings reports we're starting to hear, and we've been hearing for a while now from retailers and wholesalers suggesting that perhaps the consumer isn't that strong. But don't tell that to the policymakers who are looking at the headline numbers. We probably need to see some slowdown in spending. Arguably, we're now seeing that already in order to get inflation under control, Yellen said. The core measure of price increases, which strips out food and energy, is quite high, she said. Inflation has really come down a lot, which is true, it actually has, and there's more in the pipeline, she said, partly due to an expected adjustment in the housing market. Now, this is true What we know is that primary rent equivalent that the Fed uses is a very lagging component of the consumer price index. It's also a very large component of that. So as that rolls over and heads down, she's right. We're going to see a further decline in inflation, but there's some other aspects here too, is we're going to see demand come down. And this is something the policymakers don't believe is actually going to happen. And just take a look at that advanced retail sales chart. Again, we still have that in blue. And now we're going to overlay the net percentage of domestic banks tightening standards for credit card loans. That'll be in red. Anytime that red line is over the horizontal black line, that means on net banks are tightening standards for credit cards. Even if the red line's coming down, as long as it's above the horizontal black line, it means on net banks are tightening. And what do we know? We can see here during the dot-com bubble, banks started tightening standards for credit cards. And look what happened. Retail sales growth slowed and stagnated. Look at how going into the global financial crisis. Again, banks started tightening lending standards, and next thing you know, retail sales came down. It's starting to happen again, and it starts to make sense because consumers, particularly here in the U.S., buy a ton of stuff on credit. So if suddenly they can't either get new credit or expand the limit on their existing credit, then they can't spend as much. Well, that means retail sales go down, and that's exactly what we're seeing here. And again, you look at these policymakers, they can't look at the banking system, they can't look at their own data and draw a reasonable conclusion. Instead, they think that retail sales are going to remain robust because the labor market's going to stay strong, but that's a case we're going to say is not going to last. The U.S. economy is now seeing skirting recession risk, but with sticky inflation. So here we're going to look at another article where we see experts say that, look, a recession in the U.S. may be a soft landing, likely a no landing. Look, this isn't going to happen at all, because when we get to the data that came out today, you're going to be blown away as you see that we are indeed headed into a globally synchronized recession. As economists surveyed no longer see consecutive GDP contractions because they now expect the economy to narrowly dodge a recession this year, but think underlying inflation will be faster than previously thought. Gross domestic product is now forecast only to contract in the final 3 months of the year and is projected to merely stagnate in the third quarter instead of shrink. Now, let me ask you a question. Do you think that we're going to narrowly miss a recession? Do you think that this is actually a no landing scenario? Because one thing that you should not be narrowly missing out on is all the gains in your trading account. Now, many of you have said, hey, does that CTA-Timer Pro really actually work? Well, let me show you a recent thing. We've been put out a list on Wednesday and on the weekends, giving our subscribers tips of these are the ones to look at, and we've had soybeans on our radar. What I want to show you right here is when our report signaled a buy. That morning before market open, subscribers got the report and says, look, this is where you would want to start taking position. Look at this thing take off. In fact, I had one subscriber send me an email saying, look, this report is like buying Bitcoin at $1 because it's so easy to use and it works so well. Check this out. Here we can see on June 8th, you here look at the machine positioning. They were 100% short on the fast and slow algorithm. And our program, not only does it look at the machine positioning, it adjusts it based on a historical basis. Look at this. On 6/9, the fast algorithm showed the machines were buying. All you had to do, if you just wanted to follow the report, you started building your positions there, throw on a stop loss or a trailing stop, and then raise that up as price goes up. I've had people write to me and say, look, I've never traded some of these things before. I just followed your report. It was so easy. I can't believe it. It's $30 a month. Link in the description below. You don't like it, 30-day money back guarantee. Let's continue on. A survey of 71 economists from June 16th to 21 showed stronger views of the labor market. So here again, we still get this sign that the labor market is robust as forecasters mostly see increased hiring this year and next, and they also expect the unemployment rate will peak at a slightly lower level, which helps explain projections for sustained consumer spending. But if we make the case that we're heading into a globally synchronized recession, when I got a whole bunch of data to validate that, the labor market cannot stay strong. It's not possible that employers are going to hang on to people when demand for their work is going down to nothing. And that's what's changing here, and people can't see it. But let's look at the net percentage of domestic banks tightening standards for credit card loans. Again, we'll put this in red, and we're going to use that baseline and have that in green. So anywhere above the green line, banks are tightening on net, and I've got them circled here. And we're going to overlay the 4-week moving average of initial claims in blue. And what we can note is that when banks tighten lending standards for credit cards, as we've discussed, spending decreases. And if spending decreases, it means demand decreases. It means you need fewer employees. And lo and behold, right alongside that, what do you see? The 4-week moving average of initial claims rise going to the dot-com bubble. You see it in the global financial crisis, and you're seeing it now. The only difference is policymakers can't see it while you can. The findings also support the notion that the housing market bottom has passed. Why sales of previously homes are struggling for momentum. Buyers are seeking new construction, and builders have been responding to demand. Economists see that trend continuing with higher new home sales over the next year and more housing starts. Now, I don't have a chart of this one to show you because I want to get into the data that came out today, but let me suggest to you this. If people are losing their jobs, you know one of the things they don't go out and buy? If you sell a new home, you got it right. Let's head over to Japan. I want to go through these reports that came out today. We have these what are called preliminary purchasing managers index. This is from the S&P Global. We've got them from around the world, and I want to show you how the manufacturing sector of the world is headed into a recession, in some cases a deep recession, because what it's telling us is as manufacturing heads into recession, they're eventually going to lay off, and as that turns, we know that the services sector follows with a lag. So what goes on in the rest of the world, and wait till you see what's happening in the U.S. already, it's going to have a big impact and send us all into a globally synchronized recession. Here we see from the S&P Global business activity growth. This from Japan. They're looking at their composite PMI, which is a blend between the services and the manufacturing. But we're going to fixate on the manufacturing side for now. Slips to a 4-month low in June. Now look at this flash manufacturing output. June 48.4. Remember, the way you read this number, if it's below 50, it's contracting. So this is a slight contraction here. It's not huge, but last month it was at 50.9, virtually unchanged from the month before. The headline manufacturing purchasing managers index fell from 50.6 in May to 49.8 in June. Preliminary data pointing to a renewed deterioration in the health of the sector. Japanese good producers signal fresh declines in output. Again, this doesn't tell you, hey, the global economy is turning around, and do business. So rates of contraction were only mild. But get this, new export orders fell at a solid pace that was the steepest since February. So you start to think about, are you going to see robust hiring going on in Japan? Well, at some point, if these new export orders don't start turning around, because new order demand is critical, they're going to start laying off too. And here we can head over to Germany, which is in dire shape. Look at their manufacturing PMI. This flash data came in at 41. Now keep in mind, when you see a number on this side, a print of 45, it means that sector's in a recession. Now what's telling us the manufacturing sector in Germany is heading into a deep recession. This is critically a big problem because Germany is the manufacturing hub of Europe. Where Germany goes, the rest of the peripheral countries will soon follow. And business reported a worsening of demand conditions. Wait a minute, we're just hearing policymakers saying demand's going to be strong at the end of the second quarter. This was underscored by a second straight monthly reduction in total inflows of new work. That's critical. Remember, new order growth is everything here, with rate of decline quickening to the fastest since last December. Weakness remains centered on the manufacturing sector, where order books fell at the sharpest pace for 8 months amid reports of customer hesitancy and destocking. But come down here, and you look at this, while employment continued to rise in June and at a rate that was above a long-term trend, job creation slowed to a 3-month low and was increasingly uneven across the two monitored sectors, as factory workforce growth came close to stalling, with manufacturers registering only a fractional rise in employment. It was the smallest seen for almost 2.5 years. So you start to look at this and you see, hey, wait a minute, the manufacturing sector is slowing down and they're still hiring a little bit. At what point do those hirings turn into firings? You can only imagine, not a whole lot longer. Now let's zoom out to the Eurozone. What do we see here? The broad manufacturing PMI for the entire Eurozone at 43.6. Again, this is definitely now in recession territory. Let's take a look at what they had to say. If the slowdown had been signaled in advance by near stagnation, here again, new business inflows in May. with a new business trend measured across goods and services worsening further in June. As new orders dropped for the first time since January, the deteriorating demand environment signals downside risk to output in July. So already forward-looking, which is what new orders do. Manufacturing remained the principal area of weakness, with factory output falling for the third straight month and at the fastest rate since last October. The resulting steep production decline was driven by an increasingly sharp downturn, here again, and new orders for goods, which fell to the greatest extent till last October. So again, you keep hearing this sign, new order demand is going down, but somewhere in the region in the U.S., policymakers are like, wow, look at the labor market, it's so strong. They're going to be demanding goods and services from all of the world. Well, not exactly. Now let's head over to the United Kingdom, and theirs actually is looking a little bit better than everyone else, hovering just above recessionary levels at 46.2, but again, slowing down. This is on, again, on a preliminary basis, so the final number, we'll see if it gets better, but slowing down from that print of last month at 47, showing continued contraction as output levels in the manufacturing sector decreased moderately during June, and the rate of contraction was unchanged since May. Production cutbacks, again, there you go, were attributed to falling new orders, shocking amid subdued underlying demand and a headwind from customer destocking. Total new work across the UK private sector increased only slightly in June. In contrast, manufacturers experienced a steep and accelerated fall in new work, with survey respondents citing weak market conditions at home and, shockingly, abroad. Now, let's head over to the US, where we see our turn is coming. Remember, we get it with a lag. All these other countries that are mainly export focused, they see it first, we see it next. Here we see the U.S. economic upturn slows in June as dependence on services grows, as everyone's hoping the services sector turns the economy around. But look at this, flash, U.S. manufacturing PMI down from 48.4 last month to a preliminary 46.3, teetering on the edge of a recession. That means manufacturing sector is almost there. As the S&P Global flashed, U.S. manufacturing PMI posted 46.3 in June to signal a sharper deterioration in operating conditions across the manufacturing sector. The decline in the health of the sector was most severe in 2023 to date and stemmed from marked reduction in new orders. Manufacturers recorded the fastest rate of contraction in new orders since December 2022, with weak demand linked to muted customer confidence. Some firms also noted the sufficient stock levels as clients had led to lower new orders. Similarly, foreign client demand remained subdued. Although easing from that seen in May, the pace of contraction in new export orders was steep overall. So what you're seeing is this massive decline in new orders. It's not just one country, it's not just one region, it's around the entire world. And you start looking at new orders. Again, let's come back to the Philly Fed data, one of our favorite data series because we have a ton of it available. Here we can see new orders in blue. Every time you see new orders start to head down, even though it is a noisy data series, as it heads down, what do you note? The 4-week moving average of initial claims rises. We go into recession, and what happens to a recession? Because there's no demand, it means inflation comes down, and that means, in this case, we're facing a hard landing as the world faces a globally synchronized deep recession. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.